Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, it would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 154. As always, joined with the three amigos, Rich Diaz, Pete Dicker. What's going on, Boomer?
Hey man, Boomer's back from Ottawa. We had a real fun time there a few days ago. We'll chat about that. But otherwise, Boomer's in a good mood. We're going to talk later about, I think, the most interesting day in the last 15 years in markets. So lots of excitement about that. Oh man, it was unbelievable what happened. Today's Thursday, right? So this would have been Wednesday, yesterday. Or if you're listening today on Friday, it's 2 days ago. See, the Loonie Hour math is even working after a few days in Ottawa. How about you, Rich?
It's good. I'm in my new digs. Yeah, that's an interesting development. But yeah, no, I got my art back, and you'll see slowly but surely my art will invade and take over all of the walls in my house, which I'm really excited about. But otherwise, it was just really, really good weekend in Ottawa. Super fun. It was way too hot. But yeah, I just want to say hi to a couple of people who we met. Joseph, the farmer, he'll know who I'm talking about. He'll be pleased to hear his name. And the two cooking ladies, which came up to me and said hi. And just in general, thanks so much to everybody who came out to hang out and chat. Maybe the room was a bit too small, but other than that, I thought it was a great time. And yeah, thank you very much to everybody. Feel really honored to meet everybody.
I think Ottawa, that was a good barometer for a live event to do like a live podcast. So there was a lot of demand for that, and I think that this trial balloon, it might just work. It might just work for Ottawa. So yeah, no, it was a good conversation with everyone there, but busy week this week. We want to frame up Canada's CPI inflation data. Our fearless leaders again. Happy about the 2%. We're back to target 2%. So we'll get to that. We've got the U.S. Fed, the Fed meeting that Keith just referenced there. You got the Bank of England. You got a lot going on. So just a enormous week. But this week I think is particularly important, where we had a huge announcement. I was, we were in Ottawa there, and then we got back on Monday, and just to see the huge announcement on the housing market is the federal government, the Liberal government, announced a huge change to the mortgage insurance framework in Canada. So we got Ron Butler coming on the show to kind of walk us through that from the mortgage perspective. I think he's a guy that's incredibly well connected in the industry. I think Butler Mortgages is one of the largest mortgage brokerages in Canada. So really excited to have him on again and kind of walk us through that, because I think it's an important policy. I think the timing around it is very, very interesting. And so we're going to walk through that with Ron today.
I have a question. Do I eat my Twinkie before Ron gets on or after?
It's two for you, no?
Well, that's why I'm asking. Should I start now? It's going to take me an hour to finish it.
What about you, Boomer?
Yeah, I have.
No.
I'm such a cop.
I don't. Yeah, I know. No, but I have a true fru.
Oh, this is what happens when you go to Ottawa. You start reneging on your promises.
I don't know what this is. It says it's a Nature's Blueberries, hyper dried, fresh in creme. So let's try out these suckers. Okay, here we go. Let's do a taste test. They look like blueberries and with stuff wrapped around them. So I'm going to do 7 at once.
Oh God.
This does not count.
This does not count.
This guy just finds whatever he's interested in the week. Lemon loaf, cinnamon buns, chocolate chip cookie.
There's a bit of a crunch.
Oh God, Ron Butler,
a little
help us.
chewy. It's a little chewy. And the flavor is mild, which I like. It is sticking to the teeth. I give this an 8 out of 10.
Okay.
All right,
And that's it.
Ron Butler.
That's mine. That's mine. What do you
All
got
right,
there, Rich?
let's get Ron Butler in here. Enough of this. I don't need to hear you chewing on the microphone.
Once again, the true Fru. I think it's Costco again. I think it's a nice photo on it if you look at it.
This is not a sponsorship. This is not a paid ad. All right, without further ado, let's bring Ron into the room. Ron, welcome back to the Loonie Hour. I don't know if this is your second or third appearance, but it's a pleasure to have you on.
Hey, look, you guys are basically my favorite first, second, or third favorite podcast, depending on the week. So I'm really happy to be here. Thank you.
Oh, I love that. So big week this week. I wanted to kind of really pick your brain on the federal government, kind of out of the blue. You recall, for our listeners, about a year and a half, 2 years ago, over the last couple of years, the building community, the mortgage community has been lobbying the federal government to increase the limit on CMHC insurance from 1 million, and they were lobbying for 1.25 million. And the feds, they rejected it. They turned it down at their last budget meeting. Former CMHC Evan Siddall would be rolling in his grave. All of a sudden, out of the blue, they just jacked it up to 1.5. There was not a whiff of this anywhere out there. I don't know. Maybe you caught it, but what do you make of this? What's the
Evan's alive, by the way. I just want to let you know, Evan's alive. He's still with us.
He's quiet out there.
By the way, all the associations, whether it's the mortgage people, the real estate groups in Canada, the builders associations, the construction people, they've been lobbying for $1.25 billion cap for about 5 years. Like, it's been relentless. There was a little bit of very quiet noise of this about 2 months ago. It sort of started with the strange move of only allowing 30-year amortization for new construction purchases. That happened. You might recall that happened about 2.5 months ago, and all the parties came to the government and said, "What? That's like 1%. That's might as well do nothing. Might as well have not done it." But I think we can easily, all of us, the whole group of us, can just chalk this up to one thing: Liberals at 22% in the polls. Okay, that's the only reason this happened. There's no other reason. It's something the government, the Department of Finance.
Did they go up over the weekend?
No, not at all. So this is something that the Department of Finance, the people who think about housing in the Department of Finance, said was a terrible idea for the whole 5 years that it was being lobbied for. The people at CMHC all said it was a terrible idea to increase to 1.25. So obviously a jump of 50% to 1.5 million is purely political in nature, nothing else.
So walk me through this on the fact that there's a couple nuances to this, right? Which is like, okay, so there's one argument that says, well, hold on a minute. So you're telling me, I think, on a $1.5 million purchase, it's called 1.499. So you're just under the cap. You could put down, what is it, 150,000 is the minimum down payment for that? Something like that.
Under the new program?
Yeah. Basically where I'm getting is that so what? Someone's going to take on a $1.35 million mortgage. I mean, how many people are actually going to qualify for that amount? So that's argument number one, which is, well, how many people are going to argue this? So I'm kind of curious to hear maybe your rebuttal on that side. I've got a few thoughts of my own, maybe the tinfoil conspiracy hat, but we'll get to that in a sec.
Sure. We're not quite sure what the official maximum down payment is going to be yet. There's going to be a bunch of things happen next week. on this issue. It could be 125. It could be less. In theory, it could be about 101,000 on a $1.5 million, $1.4999 million purchase. Okay, so that's theoretical. By the way, there's about 90 to 100,000 of insurance premium we're talking about here, right? So the mortgage isn't going to be 1.3. It's going to be right back to 1.4, 1.4 and change. Okay. Yeah, no, it's the numbers are massive. They're just huge, huge.
I mean, basically you're 100% LTV out of the gate.
Yeah, that's the way it is with the $1 million cap. You're at 98.3 out of the gate. Yes, that's correct. So look, it's a huge number. The income required today at today's rates is about $308,000 to qualify. That's the income you have to qualify. That's also based on no big car leases and on and on and on.
So the 1%, that's the 1%, right?
That, well, it's about 300,000. Family income is about 1.6, maybe 1.8% of people in Canada. That's about what it is. So yeah, it's definitely the metaphorical equivalent of 1%. Yeah.
Unless you get go ahead. We
haven't talked about cosigners yet. Okay. So yeah, you can, it's obvious, and we see it every day. Well, it's a lot less now. Obviously, the real estate market is quieted. We just got the report today out of Toronto. New construction was 43% off last year's bad numbers in August. I mean, like, it's literally a new construction apocalypse in the GTA. So, which leads to the conspiracy concept is absolutely correct. But yeah, we are looking at a much slower mortgage market. So we just don't see much at all. We see a lot more normalized purchases in the last 6 months. But this is kind of an invitation to go, if you want to have a semi-detached or a nice townhouse or even something nice in the GTA to live close to your parents, wouldn't your parents want to support you by guaranteeing this, signing on as a guarantor on these mortgages? So we may be looking at a whole new world next year in the spring for sure.
So you might have 8 people co-signing on one mortgage.
There could be a number. Yes, it could be a number. But look, it's a CMHC mortgage. It's got restrictions around guarantors. You have to be parents, grandparents, blood relatives, that type of thing. There are real restrictions around this thing. I mean, a lot of people suggest that it could be used to purchase rentals. There was a brief rumor about that died down quickly. It's not impossible, but it's not easy. It's just not easy.
Can I just walk people through that for our listeners that are maybe less involved in the mortgage industry? So CMHC, Ron, their current guidelines suggest that, or not suggest, they state that you can only use CMHC insurance for the purpose of buying a principal residence. So you can't go out there and say, I want to add to my rental portfolio. I'm going to put down 9% and leverage it up and run it through CMHC. I think where my contention is, and I've seen it. You hear stories. I know it's out there. I don't know how prevalent it is, but it's out there where I think there are cases where people will state that they're going to live in the home, that they're going to state it's a principal residence. And then, a month, 2 months after it closes, suddenly it's on the rental market. And obviously, once the mortgage is typically funded, most of the times the lender isn't going back and checking and saying, oh, why is it on the rental market? Because I think, one could state that, hey, my life circumstance changed and it decided it wasn't going to work for me and I rented it out.
Well, CMHC does have a second home program for family members and the vacation homes, but this is not really the fit for that particular program. Look, we could see everything. We don't know. We could see advanced mortgage fraud now that there's a more, they've got 10 times leverage on a $1.5 million product. There's lots of things we could see. The truth is, yes, some people there's two things about these CMHC mortgages. Great leverage. I mean, it's as much as low as 5%, as much as about 10%. So that's much bigger leverage than 20% down payment. So it's interesting to investors to think about the leverage. And number two, it's the lowest rate. This is consistently a rate that's between 15 and 30 basis points less than the best available conventional rate. So there's a couple of different reasons it's attractive.
Which it kind of tells you all you need to know, though, too, from like the bank's perspective, is like you're underwriting mortgages, what on average, Ron, 50, 60 basis points lower than an uninsured mortgage?
Well,
40?
probably about 40 to 20 than a regular mortgage. 40 to 20 basis points cheaper. It is consistently the best rate in Canada. Yes, the CMHC rate is the best rate in Canada.
And that's because basically basically that mortgage gets passed on to the taxpayer. It becomes the taxpayer's liability via CMHC.
Well, we got to be reasonable about it. Like these companies, the three companies involved, CMHC, Canada Guarantee, and Sagen, have massive reserves. I mean, they are insurance companies. They have huge, huge reserves. But the fact is that the securitization is at the best possible rate because in the case of CMHC, it's 100% backed by the government. In the case of Sagen and Canada Guarantee, it's 90% backed by the government. So it's a kind of a version of a sovereign debt that is obviously attractive in the bond market.
Okay, sorry, and just to interrupt there, can we just like basically simplify and dumb this down for the audience?
For me.
Yeah. So Ron, give us a go. Let's just do like a very generic, basic example. So let's just say I'm a home buyer today, and I want to go out there. I'm going to buy $1 million condo in Vancouver. I'm going to put down, let's say, $100,000. So I'm levered. I'm taking a $900,000 mortgage. So I go to, I don't know, TD Bank, and I say I would like a mortgage. They run this thing through CMHC. Can you walk me through that? So I pay the insurance premium. The insurance premium goes to who?
Sure, let me walk you through it. You buy the house, you apply through the bank, you fit the criteria of the underwriting in terms of strict debt ratios and a few other things. The bank says to CMHC, here's the basic look of this application. Would you give it an insurance number? CMHC says, yes, we'll give it an insurance number. There you go. Here's the number. There is a big, $50,000, $60,000 premium, which is then added to your mortgage. It's added to your mortgage. And then that's issued, and the bank can securitize it into a less costly channel. So at the end of the day, we should think about claims. I mean, that's really where we should come around to. Like, what's the story of the claim? You don't make the payments. Okay, you don't make the payments. So CMHC jumps in. The bank contacts CMHC. Hey, look at that. They're not paying. You got to look after us. So it's a claim. So CMHC then, at that point, CMHC then does a deep dive in the file. They ask to see all of the paperwork. Let's face it, insurance companies aren't in the business of paying every claim without any, hey, yeah, sure, we'll pay you. No, that's not how insurance companies work. Now they want to see the file. They didn't actually want to see any of the backup documentation when they approved it. They took the bank's word for it that they were checking when they assigned the insurance number. So now we got to say, okay, let's look at all these documents. Oh, look at this. I don't think this income was really properly managed or anything like that. We don't like the look of these backup documents. So that's possible. It's very rare. Let's just move ahead and say that CMHC says, okay, we're going to deal with this for you. We're going to pay you off on the mortgage bank. We're going to pay you the full amount of the mortgage that you have outstanding. Pay the whole balance. Okay. So at that point, CMHC contacts the homeowner and says, hey, we want to help you. What can we do to help you to get you back on track? And the homeowner says, well, I lost my job. My spouse lost her job, and I'm screwed, and I'm never going to make another payment. Okay, CMHC then goes into the process of evicting the person. Unless they just walk away, CMHC goes into the normal power sale process, foreclosure process, and the property eventually is sold. So the CMHC didn't lose the whole $1 million loss. CMHC sold the property for $900,000, took on a bunch of legal fees and administrative costs, and probably took $150,000 loss. That's probably what happened. So in that situation, CMHC has billions of reserves, or Sagen or CG have billions of insurance companies. They have reserves. So they take that money out of reserves and move on to the next. That's the process. That's how it looks.
And what happened to that $50,000 insurance premium that was paid that was tacked onto my mortgage?
Well, that's why these companies have a wonderful net margin. Whether it's CMHC or CG or Sagen, these are wonderfully profitable insurance companies.
Yeah, and that so because people will say, well, hey, listen, like if you look at CMHC is a profitable corporation. It's been beneficial for the taxpayer. I mean, I'd argue that we've never really been through a material down cycle in 30, 40 years, but um so people would say, well, why not just pump out more $1.5 million mortgages? Because hey, it's been profitable for the federal government vis-a-vis the taxpayer.
Well, everybody on this show knows the issue. It's demand stimulus. It's in a look. We're a country where, by definition, if it's the government-sponsored program, we have now said to everyone in Canada, $1.5 million is some version of a starter home, because that's what this is all about. This is a program to help Canadians get into their first home. So by definition, it's a starter home. So in the United States, that number is $766,000. Okay, it's half. It's going to be half of what the United States thinks a starter home should be. It's because they have a similar program. It's not insurance, it's something else, but it's similar. So you can go as low as 1.5% down in the United States if you served in the military. So what I'm saying is that everybody has this kind of a program, but nobody, not even Australia thinks that $1.5 million is the government-approved starter home. So demand stimulus is the whole story here.
Yeah, just to clarify, just to clarify, this is only CMHC mortgages. You don't have to be a first-time home buyer. You could, as long as you're an end user, Ron. So if you're saying, hey, you know what, I'm on to my third home. I just got a divorce. I was starting a new life. I'm going to go buy a home for 1.2 million and put 11% down. That's okay.
We don't know yet. There has been a lot of discussion in the initial press release, which in some ways was a little confusing, that this is only going to apply to people who have never owned a home before. So we're going to wait for all the details to roll out by the end of next week, and then we'll know a lot more.
Okay. Rich, you have a question?
I just have a quick one. So what is this? Forgive me for maybe this is too simple a question, but what does this do for affordability? I mean, ultimately, that's the real issue we're dealing with. And I was just wondering, what does it do for affordability?
Well, every economist will tell you it harms affordability. Every economist would tell you that any demand stimulus in the face of reducing supply, because incredibly, that's what we've got. It's so shocking. We've had every government, whether it's a city, a province, or the federal government, telling us they're going to build an enormous amount of extra homes in the next 7 years. And yet the new home starts decline every year for the last 3 years. So it's obviously demand stimulus. So it harms affordability. The government, Krista Freeland said it was trying to make new homes more affordable for young Canadians. So 1.5 million? Like, sweet Jesus. I mean, that's unbelievable. So yeah, it's just demand stimulus.
Yeah, so she did call it she called this as much as a quote supply side measure. And I think what she was alluding to was basically that this was going to hopefully stir more demand for pre-construction purchases, et cetera, to basically help the development community out. Ron, as we know, the GTA new home sales year to date, I think we're at 20-year lows. Vancouver, we got data that goes back to 2017. This is probably the worst since then, close to it. So the new home segment is incredibly weak. Where I put my tinfoil hat on is, and I know a good friend of the show, Ben Rabideau, has talked about this a lot. I think there's a real concern around the pre-construction market in the GTA, which is to say that
absolutely, yes.
but not just from like hey, new home sales are collapsing, but hey, you bought a pre-sale in 2021, 2022, and it's coming up for completion in the next 6 to 12 months. And what is it going to appraise at? And so one of the things where I put my tinfoil hat on, I say, okay, you bought a pre-construction home. Let's just say you bought it for 1.4 million. Well, it's now appraising at 1.3 upon completion. There's now a shortfall. How are you going to cover that shortfall? I mean, I think a lot of Canadians don't just necessarily have an extra $100,000 to throw into this deal to get this deal closed. So you've got this shortfall. And so at least now you can say, well, hey, I'll just run it through CMHC. I'll just put less down. I'll take more leverage, and at least I'm able to close. Because I think I think there is a real concern about closing risk on all of these record number of units that are under construction that were people paid enormous sums of money for them. I don't know if that's super conspiratorial. I know that a good chunk of the pre-sale units are sold to investors, and you can't run investment units through CMHC. But like I said, how many will be fraudulently done as principal residences, and then how many are people just buying principal residences that again are going to have a shortfall in their down payment?
Well, really quickly, in the words of the other boomer on this podcast, hope is really not a business strategy. It's not a strategy. But to address your thoughts, you're right. I mean, down a narrow path, there's a very narrow path to it. But yes, this could save someone who has seen the value of their pre-construction condo drop. Now, there's a tight underwriting path. It's not going to be easy, but it's not impossible. That's absolutely true. Now, what this may be, and I don't even think you need a tinfoil hat for this. What this absolutely could be is a way to tell developers who are dead in the water right now, look, you can start taking 5% deposits if you can finesse it with whoever's providing your construction financing. And as long as you've got that pre-approval that has the CMHC stamp of approval, maybe you're going to be able to take less deposits. You're going to be able to get to 75% pre-sale on your building, and you can start building again because that's been dead for 14 months. So you're not far off. It may not always work just to save somebody who already has 6 dog crate condos. Nobody's going to believe that this next one is going to be, oh yeah, you're going to live in that one. Sure you are. So it has a narrow path. It's possible for some people, yes, but maybe it's a way to get new construction started again. Yeah, that could be absolutely the case.
I got
one question.
More. Go ahead, Keith.
Go
ahead.
How about just share with everyone who's listening here, how does this change a potential buyer's mind? So say a couple, they're renting a 2-bedroom somewhere, and I don't know what the rent would be in GTA, but you share us what that rent might be. And does this make it now more attractive for them to buy a condo or a house? Or is it more, and it still comes back to an economic question at the end of the day for everyone? Hey, am I going to keep my job now? Do I need to work more hours or something like that? Like, is it going to encourage, besides Steve's perspective on what might happen on the builder side, is it going to encourage a new buyer to actually go out and buy something? Is it cheaper for them to do it now?
It's a good question. So you're right. In bad economic times, people's minds don't trend to, oh, maybe this is the time to buy a house. You're right. That's correct. So if the recession proves that we're probably in a per capita recession right now, have been for a while, if that proves to be the overwhelming influence, you're right. That won't change that couple's minds. Okay. However, if they've saved up $115,000 and they only want a townhouse in a particular location in the GTA, and they needed $200,000, then in theory, this does present, and the townhouse was $1.2 million, $1.1 million, $1 million something. Okay. This does indeed present an opportunity for them to say, well, look, our jobs are secure. You work for the government. I work for a bank. We can finally do this now. We have $118,000 saved up. The townhouse we like is down to $1,080,000, $1.12 million. Let's go. We can do it now. Let's do it. Okay. Yes. So that's the two-sided answer. For those that have worries about their future job situation, which is consistently worsening, particularly in the GTA, we have 8% unemployment in the GTA, not 6.6. We have 8. So, and rising, obviously. So for those that aren't worried about it because their jobs are ultra secure and they've saved up 120,000, yeah, this could be a game changer, 100%.
So can I ask you just a slightly different question, which is, so I see this sort of as through the lens of an economist, and you've mentioned about, that the insured mortgages are cheaper. And you also mentioned that the loan to values are higher, meaning you need to put the less money down. And the number 1.5 million is an astronomical number. And I just quickly did it. And so that, on a 25-year mortgage, fixed rate 5%, it's $6,000 or $7,000 a month.
30
or
years
something.
now. 30 years now.
Yeah, excuse me. Sorry.
It's $7,000. You're right. It's $7,000. That's correct.
Yeah, and I was just thinking, like, given that the interest rates are actually lower, I mean, isn't this a wholesale transfer of risk from people who might otherwise not be wealthy and putting a 20% deposit on a $600,000 home to someone who actually might be very, very wealthy, making $400,000 and paying, buying a $1.5 million home? I feel like, and just to repeat that, it's a transfer of wealth from the people who may not actually have that much money to people who are in the top sliver of income and asset holders. That's sort of the way I read it.
Well, those people all at $600,000 unit always had access to CMHC if they qualified. They always had that forever. Okay.
Right, I know, but a 95% loan to value is not a sensible way to purchase a home. That is I don't know.
Rich, I am even actually old. I'm the oldest person on this podcast right now. Okay, I'm 67, so I can tell you that 30 years ago, 50% of all home purchases were less than 20% down. Okay. So, it's just a different world we live in because we've detached from rational income versus price. Income versus price in the home buying business should always be about 2.5 to 3.5 times income should be the purchase price. So with this new standard of a $1.5 million starter home in Canada, we've now moved into government approved 12 times territory. So yeah, this does not make any sense at all. You're right.
And just one last thing, just really quickly, just so we talk about the transfer risk, we talk about the 12 times income, which is absolutely insane. Given where we are in the cycle with respect to household debts, with respect to affordability, is this like literally the worst thing we could have done for housing?
Well, maybe not the worst, but top 5 dumb. Yeah, absolutely. Okay. Top 5 dumb. This is demand stimulus in a falling supply market. With governments trying to protect their ass and buy some votes. I mean, that's all this is. If you've got every single association in Canada saying, please, we want this aggressive target of 1.25 million, and they're constantly told no for 5 years, and then suddenly the government says, you know what? It's mortgage Christmas. Let's have 1.5 million cap. Okay, like it's almost. It takes your breath away, to be honest. It takes your breath away.
What's the general sentiment, Ron? I mean, in your industry, are people, is the broker channel quite happy and elated? I know you're a bit of a contrarian, probably a bit like myself, but what are you hearing?
The word orgasmic comes to mind. Okay, I mean that's about it. I mean, like it's such an it's such an incredible thing. Like we've been begging for 1.25, and you jumped us all the way to 1.5. Wow, wow. I mean, this is the best thing I ever heard. And 30-year AM, everything we asked for, you gave us more. So yeah, they're very, very excited. Very excited.
They'll get some votes from the mortgage community coming up. So I got a question. I don't know if you know the answer yet, but this is something that we've been pulling some threads on here. Do we know regarding the 1.5 million CMHC cap? Will this also apply to bulk and portfolio insurance?
It will not apply to bulk insurance.
Okay, so that's confirmed.
What does that mean? Sorry, I have no idea what that means.
Well, if you have under certain circumstances, certain underwriting circumstances, if you have previously, if you had a property that was less than $1 million, there was some way you could finesse not a refinance, just a transfer of the mortgage at these low rates. Again, we don't have all the background to this. Those details come out over the next few weeks. But again, it's solely designed to work for new purchases, for new construction, for new buyers, people who've never owned before. Now, there was a paragraph in the presser that said that it would make it easier for people to transfer mortgages from who already existed that were purchased for over $1 million, to switch those mortgages to a new, better rate, so enhanced shopping. Now, the point is, though, that you can't get any increase. When you do that, you cannot increase the mortgage at all. So it's a bit of a fairness issue, but it's not like the old days where we had bulk insurance. We could get great rates right out of, one of these other lenders that specializes in insured mortgages. So there may be some help and some more benefits to people who are transferring mortgages from point to point. But the old days of the pure bulk insurance, get your great rate on a refi, no, we don't have any of that available.
Thank you.
So right now, then we have higher CMHC limits. Bank of Canada, they're cutting rates. Is this one of these enjoy the moments? Hey, it's going to get even better, or is it a sign that something is actually deteriorating underneath?
Yeah, I feel like, yeah, go ahead, Ron. I feel like they tipped their hand. No, it's just an odd time to be dropping.
Well, I guarantee you Tiff Macklin did not enjoy that moment when Minister Freeland jumped up and said, we're going to increase this cap. Okay. That was not his finest hour. Okay. He probably saw that announcement. He probably knew about it about a month ago, but yeah, it's the Bank of Canada. I'm sure if you could get a few drinks into them, the Carolyn Rogers and Tiff Macklin would say, yeah, this is just ridiculous. Absolutely ridiculous.
But the Loonie Hour is pretty good at having drinks at events. So we should get all of them together. We'll have some truth serum.
The truth serum. Absolutely. The truth serum. So look, they don't like it. They understand it's demand stimulus. And that's the thing that they kept on and on and on about was we've got to make sure that this doesn't overstimulate the housing market as we drop rates. But that ship sailed after the Fed's cut yesterday. The rates are just coming down. That's all. The economies are North America deteriorating. Probably the economies in most of the world are deteriorating. And, nothing's going to stop this rate cut. It's the train's left the station. So yes, next spring we'll have both a lower rate scenario, significantly lower than today, both in fixed and variable, and we will have much more aggressive rules for CMHC. And if that doesn't signal support for the housing market at all costs, support for real estate at all costs by the Liberal government of Canada, I don't know what else could.
So one last question, and you touched on it just half a second ago, which is, is this government just pure and simple unwilling to let the Canada suffer the necessary pain to readjust our economy away from housing? Sorry, Ron and Steve, which is, in my view, the only way that you'll improve productivity growth and ultimately help the working class. Like, that's it. We're never going to let any kind of reset happen.
Well, in 2008, in the United States, the U.S. government was prepared to let hundreds of thousands of people lose their homes. And they did. They absolutely did. Hundreds of thousands of people lost their homes to their bank during the world financial crisis of 2008 in the United States. The United States has never been afraid to let capitalism actually run its course, although they will save banks. Yes, they will save banks in the U.S., no question at all, but they're happy to let average citizens go bust in order to maintain their view of capitalism. It is kind of clear here that we have politicians that just want to keep things moving along as they are. And there is no question that the government of Canada is prepared to defend real estate in Canada. By the way, you're starting to hear some of the people they use as proxies start to talk about the fact, we've heard it, you can never destroy the retirement plans of Canadians by letting real estate drop. We hear that from their proxies now on a pretty consistent basis. So I think the cat's out of the bag. It's all in on real estate from Canadian governments.
Yeah,
Steve is telling that story all the time. He's a
Ron, I just think this one reeks of moral hazard, right? I think, like, if you talk about housing affordability and we care about these young people, it's like, let the prices drop. The prices are in the process right now of dropping. Let them drop, then houses will get more affordable. By adding, changing the rules to add more demand and stimulus to the market, I don't see how that's going to make housing more affordable. Every time the housing market wobbles, we intervene. I think that the pandemic was a clear sign of, hey, rates will be low for a very, very long time. You can go and borrow money. And by the way, if you're behind on your mortgage and you own 4 condos, just defer your mortgage for 6 months. So no worries, we'll take care of it. And so I just think every time that housing wobbles, as it is now, the government comes in with these big rule changes. And I think it's just, it's a signal, and it's a signal to housing speculators and just average normal day-to-day people that housing has the full support of the government, and prices will not be allowed to undergo a natural correction. I mean, they will correct, but not without the government trying to interfere.
Well, here's the most important political stat. People over the age of 55 vote consistently 40% more than the people under the age of 35. So that's the only stat you have to hold on to. The people who vote the most have the most vested interest in real estate prices not going down.
Yeah.
There's another angle to this, which is, and again, not to be political, but the ostensibly left-wing party is doing everything in their power to defend the owners of capital and not the laborers and working class, which is just tells you how screwed up this whole thing is. I'm sorry to couch it in those terms, but it's in my view, it's a fundamental change in what has gone on in this country. And from an economics point of view, it's fascinating. The laborers are just constantly under pressure from the people who are supposed to be defending them. And I find it sort of fascinating.
But I think that's by accident. That's by accident, though. I don't think it's by design.
What do you mean? They just increased the mortgage thing.
Yeah, but they're doing that to try to make it more affordable, for the working class. That's what their intention is, but yet that's not what they're doing. We're saying the same thing.
Yeah. Okay.
Except I'm a lot smarter when I'm saying it compared to the way you do.
So are you saying the $308,000 earning working class? Yeah.
Yeah, exactly.
Who's not making 308?
There you go. So so look, at the end of the day, it may be a left-wing party, but it's still a political party. So a political party always understands where votes come from.
Fair enough. Ron, I'm always, I'm always too naive about these things.
As we get closer wrapping this up, we want to be mindful of your time. We know you got to get moving here, but I guess to kind of wrap it up, I have a few questions, which is, what are you looking for now? Like, we're still waiting for some of the details of how this policy, is there anything in particular that you're kind of like, well, we should really keep an eye on this? Are they going to include that or this? Like, is there anything that you're waiting for to really get clarification that could move the needle?
Hey, we have, as mortgage brokers, we have to pay attention to the details, but the major point has already been struck. There is there's not going to be a ton of $1.5 million mortgages. There wasn't a ton of 999 purchase price. There wasn't a bunch of those. But what this is meaningful to is the 1.1 million, the 1.15 million. And that's quite meaningful to that group that felt, I don't want the properties that I can see that are below $1 million. It doesn't suit where I want to be, my lifestyle. It doesn't suit anything where I want my kids to grow up. It just doesn't suit. Suddenly, those people are going to say, well, at 1.1 million, 1.8 million, this is interesting. So it's all about the move of the cap. Everything else, all the little details are really just noise. But to release those people who feel comfortable enough in their job security to be able to buy, because that's less than 300 grand. That's like 260 grand, 240 grand. So, and there are more of those people, but at the end of the day, it's demand stimulus, and that is the major news. And by the way, for everybody who's buying any kind of CMHC insured property, the increase to 30-year amortization adds between 8.5% and 9% to what they can actually buy, to the maximum that they can actually buy if they qualify. So even if they qualify easily, now they can qualify for that much more. So yeah, this is demand stimulus at every fork of the road.
Amazing. Ron, as always, we appreciate you jumping on the Loonie Hour. We'll have to have you on for your fourth and fifth appearances in the near future. But
where's the merch? There must be merch. Where's merch? I need merch.
I'll get you some merch. That's my job. That's my job. I'll get you some
Ron,
merch.
you've also got the Angry Mortgage podcast. I'm assuming that's on all platforms.
It's on all Apple and Spotify and YouTube, and it's everywhere.
Yeah, we definitely encourage our audience to go check that out.
It doesn't do as well as the Loonie Hour, though. The Loonie Hour is like the number one.
I don't know. I think it's neck and neck. You're
no.
You're a Canadian mortgage icon.
You guys are a sought after commodity. That's for sure.
Well, we appreciate that, and well, we only get there through good guests such as yourself. So, Ron, thanks so much for coming on the pod this week.
Thanks for having me. Really appreciate it.
Another brilliant interview with Ron there. He promised us a better mic,
but we forgot to ask Ron what his favorite cuss word is. Ron is legendary for having some colorful language, and we didn't get any on the show then.
Yeah.
It's a family show.
Yeah, Keith, we definitely won't make housing more affordable. People will say, well, is the market going to go up right away? And it's like, no, I mean, I think that over time, I think that right now the market is clearly impaired on the demand side. We've got excess supply in the resale market and in the new construction market. But as that works out over the next 12, 24, 36 months from now, this rule will probably still be in place. And it's a demand side measure that will boost. It's simple, right? If you can borrow 3 times your income or 5 times your income, or as Ron said, 12 times your income, which one's going to drive up home prices more, right? If there was like a hard cap and said you cannot borrow more than 3 times your income, obviously home prices would be lower. So the more leverage that you add to a market, the more ability you have to drive home prices higher. So this is what the feds have decided to do. I don't think there's any government body. I'm sure OSFI's Peter Rutledge is not happy about it. The banking regulator. I'm sure CMHC's former CEO Evan Siddall is puking somewhere. And I'm sure Tiff Macklem at the BOC, who just finally got a positive reading on CPI, we finally strong-armed this thing back down to 2% this week. Is not going to be happy.
I thought you were just going to say he finally got a positive reading on his Airbnb, but it's sort of the similar.
He's probably got a few in his pocket, doesn't he?
Definitely.
Yeah. But with this 1.5 million cap, I know Ron was talking about the greater the GTA, the Toronto area in Vancouver. Are there any other markets outside of those two in Canada where you have to go to 1.5 to get your starter home?
So most of the CMHC mortgage, we didn't really get into it, but like a lot of the because it was capped at $1 million, most of the people that were like using CMHC mortgages were like people buying homes in Saskatchewan for $600,000 and Alberta for $750,000. Like it was very prevalent. Obviously in Vancouver, like anything, let's be honest, like a lot of the stuff that people want to buy is above $1 million, right? Like if you're in the city of Vancouver here and you want like a pretty decent 2-bedroom condo, the reality is you're probably over $1 million. So people weren't really using it. But I think more so, I think it's a signal to the market like, hey, we're going to try to stimulate demand, number one. And number two, as I still think there's a lot of pre-sales that are at risk of closing. And if you have shortfalls there, you might not have to come up with extra cash, just run it through CMHC and take on more leverage. So I think it was kind of like a quasi bailout or gift to the development community on the backs of the taxpayer.
Yes, that's exactly what it was. And I would just like to beg the people who run our country to let the market do its thing, and you will see the widespread benefits to us all. That'd be my solemn request. I find it just very frustrating. I know I get distracted by the politics stuff, but
hey, so just on that point, Rich. So Canada's switching gears here to Canada's CPI shelter component, despite the demand side stimulus measures here. So shelter costs are still elevated. So we finally got CPI back to the 2% target. We had every single government official on the Liberal Party tweeting about how the job was done and it was a heroic effort to get CPI back down to 2%. The plan is working. So, but one thing was flagged by the BOC is shelter costs. So shelter costs are still elevated. So rent prices were up 8.9% from a year ago. Mortgage interest costs, they're starting to come down, but they're still 18.8%. So those two price components alone accounted for two-thirds of the total year-over-year CPI increase in August. So shelters, the takeaway here is CPI would arguably be lower if the stubborn shelter prices are still a big chunk of the basket here.
Yeah, also I think what's really important, which you didn't mention, I'm afraid, is the energy piece. So according to Stats Canada in their release, it says the energies was the largest drag month on month, which is something I talk about a lot, and year on year. It's a huge drag. And I think the problem with that is that it's the base effects will snap back and hit you when you're not paying attention, because if energy prices go up for whatever reason, or you might get a real snapback in that energy piece. I think the other thing is that in general, it's the fact that remember, like, yes, we're back down to 2%, but it's important to reiterate that price levels are still up 30% or whatever where they were in 2018-19.
I think that's a great chart on Twitter.
Yeah.
Yeah, why don't you show that chart that I put out?
Oh yeah, we'll post that one on YouTube.
But I just want to sort of re-emphasize what Rich just said. Everyone is, they're, enjoying the moment again. Inflation is down. Inflation is not down. It's just not growing as fast as it used to. But as Rich has some great data that he's sharing right now, it's because energy prices have declined. If you take that out, what's happening with the inflation data, Rich?
Yeah, it's really strong.
Yeah, it's really strong. So, and again, it's gonna, I have a theory on why, oil prices are lower right now, but it's disappointing to hear or see and listen to what's coming out of policymakers that, they're a champion of this data point. This is great news. And when you think about it, what's the great news here? That inflation is low, or it's down low because oil prices are lower. And if you take lower oil prices being lower, for all intents and purposes, it means, say, demand is lower, yes, right, or supply is higher. It's not the supply side, it is really on the demand side. But this can, whipsaw, rebound again very quickly. And, I think we're going into a very awkward monetary moment. And, maybe that CMHC cap, maybe it'll be at, Ron, are you listening? Might be at 3 million this time next year.
Wait,
I think we're headed for a really weird time coming up.
Just one more thing before we move on. Like, I think, and you touched on it quickly, Keith, but I think I just want to elaborate, like that demand piece, we have 6 or 7% more people in Canada from 2022, and yet retail sales in nominal terms are flat. And so what we're seeing is, like, part of the reason why inflation's come down is not because of a strong economy. It's like, yes, there are some base effects, and yes, energy prices are coming off, but it's also people have allocated way more money to servicing their debt. We've talked about that. And also savings rates are going up. But anyway, so I'm getting booted off the stage. So Steve, help us.
I can't quite focus on Rich now. For some reason, but I don't know. Maybe it's a technical
issues here, the Loonie Hour, but
yeah. You have a blur. You're all blurred right now. You're blurry.
I'll fix that. I don't know what happened.
Because your voice is very clear. Your thinking and rationale is the same as usual. Wacky sometimes, but your videos. Hey, there you go.
This is Jeff's fault for messing with my video.
Thanks a lot, Jeff.
Okay, let's go back though. More serious conversation.
I got some questions for you. How, like, I agree. It's funny because, people are like, oh, well, if you strip out mortgage interest costs, like, inflation's way lower, we should be cutting. And then if you're like, well, if you add, if you don't strip out what just happened in the energy prices, inflation will be way higher. So I'm kind of curious, like, your general outlook here for Canada. And I guess Canada might be different than other parts of the world, but I have a tough time. Like, if you're negative and bearish on the Canadian economy and on housing and house prices, I tend to have to think that it should be disinflationary. Like, I'm struggling to see an inflationary impulse in Canada in the near term over the next, let's say, 6-12 months. I definitely agree that as you zoom further out, we could be right back where we started. But I'm kind of curious how you kind of square that view.
I think you're right. I think you're absolutely right. I think it is a deflationary impulse because I think we're in a recession. Sorry to front run my own videos here coming up, but I think that's I think we are in a consumption, like a depressed consumptive state. I don't know. I've made that up, I guess, in words, but retail sales are flat, consumption's flat, housing is flat, unemployment rates are rising, central banks are provisioning for more loans, credit growth is slowing. on and on and on and on. I think we're already there. And I think you're right. I think and that leads us to a disinflationary situation. And rates are going to have to come down to accommodate for that. But yeah, that's my view.
I think, though, the challenge that the world has today is that but for some reason, we've been trained out to expect these U-turns in everything. The economy's growing too fast, inflation's too strong, raise rates with the lever, and U-turn, we're back to normal again. We're slowing down too quickly. Uh-oh, this is no good. Oh, let's cut rates. Another quick U-turn. It doesn't work that way. It takes a long time for an economy to react to any kind of a counter effect or influence that's trying to alter its course. And again, we are now clearly going down this path where not just here in Canada, we got to talk about the Americans and their monetary policy from yesterday, but we are going down something that's going to hit dead on. And you may not want to see house prices to be cheaper because it's going to happen for a different reason.
Yeah, so walk me through that, Keith. We've got U-turn from the Fed, the Federal Reserve, of course. I think surprise markets, 50 basis point cut. So I think it was Bloomberg, they surveyed 114 economists, 105 of them were wrong. So 105 of them were fully expecting 25 basis points. So there was very few in terms of consensus for a 50 basis point cut. So again, Keith, I don't know what your thoughts are on that, but it seems like it was pretty big news.
Yeah, let's just jump in here. We'll try to be simple in the beginning, then go a bit deeper. And first of all, I think yesterday on Wednesday, the Fed day was the most fantastic, exciting economic financial moment over the last 15 years. And if you are an investment professional and you don't understand it, you're in the wrong business. You have to get out. So let's just go through what I mean by that. As you said, Steve, everyone knew the Fed was going to cut rates. And then it's in line with everyone else, the Canadians, the Brits, Europeans. Everyone is creating a new policy to help soften things up here, to make it better. Whenever a central bank cuts rates or raises rates, it's usually by 25 basis points in one meeting. That's the way it works. You only see more than 25 when there's a significant crisis happening. And then that more than 25, it's a reactionary. So think about during the pandemic, think about the American housing collapse, or if you can think back to when the tech bubble burst, all of a sudden it's, oh, wow, 50. That's a big thing to do, or an intra-meeting move of 25 or 50. For the Americans right now in their domestic economy, there's some data that suggests things are slowing or deteriorating. Other data points are saying, hey, it's okay. This is not bad here. So you could come up with a reason why, maybe they could cut by 25 basis points. There's nothing there showing that they should cut by 50. So the repo market is strong. Credit spreads are fine. There's no bank, significant bank in trouble, anything like that.
Labor market.
Labor markets, it's everything is okay. And depending on what, if you want to, talk your own book, you come up with a reason where it should be. Stock market is at all-time highs. So then you come down to, why the heck did the Fed just cut by 50 basis points? And their response is different from our view. And again, we shouldn't say what they should do or shouldn't do. This is what they did. If you listen to the presser yesterday, so Jay Powell and the Fed, they said, basically by cutting by 50, we're going to be able to maintain the current labor market, the strength of the current economy, because inflation's coming down. It gives us that slack that we're able to use. Again, we go back to, okay, is the economy in trouble? It isn't. There's no reason why they need to do 50. Alternatively, that's what people need to realize. Whereas the Canadians, the Europeans, Japanese, we create our own monetary policy for our own domestic economy. The Fed, they are really the central bank for the whole world. And the reason that's the case, there's a significant amount of US dollars that's created. So you have credit creation in US dollars that takes place outside of the US, so even outside of the American banking system. And that's called the euro dollar market. So when, let's just say you're a bank in Thailand or the Philippines, or you're even in Germany or somewhere, and you make a US dollar loan, you're lending in US dollars, you're all of a sudden you're creating US dollar demand for the future because someone needs to get US dollars to pay you back that loan at some point. My theory right now, the reason why the Fed just cut by 50 is not because of a domestic American problem. It's because one of the big four is in serious trouble. And, Steve, close your ears. Rich, Canada's not in the big four in the world.
Oh, we're in the G7 though, for sure, right? Still.
I know, yeah, we're like number 7. But it's either the Chinese, the Japanese, the UK, or Europe. Those are the 4 big, really markets to think about. One of them is likely, they are in trouble of some kind. And the Fed is doing this to try to create liquidity or easing for that market. Because as much as these guys may dislike each other on, in the social media world or, the Washington Post or New York Times and stuff, from a financial and monetary perspective, nobody wants to see the other side go under because you all have to work together. And I think that's what's happening. So again, yesterday's move by the Federal Reserve, 50 basis points with nothing happening domestically, that creates this huge warning sign that something else out there is happening. And again, they didn't raise by 50, they cut by 50. So it signals to us that, hey, something is going on here. And so again, we loved it as an investment firm. We did a pretty big strategic change yesterday prior to the meeting because we were able to see data was happening. So we were proactive with it. But again, from an insensitive, human perspective, we're pretty excited because it is creating these incredible opportunities coming up. And it's finally happening because we've been talking about it, for some time here on the podcast. So that's my quick 5-second introduction. Let's go a little bit deeper now into I'm joking, guys. These guys are asleep, like they're bug-eyed now. That's enough.
Asleep. I think the one thing I think you just failed to do is reiterate how rare that move outside a very specific recessionary impulse is. And it is literally, I'm looking at the chart, I can share it. It's outside of a direct recession. The last time it happened was August 1986. And at the time, you have to remember that the Fed funds rate or rates in general were much, 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 much higher. And so a 50 basis point move when your interest rates are 17 or 18% is not anywhere near as big, obviously, as a percentage, as a 50 basis point move when your rates are 5% or 4.5%. And so it is an incredible sort of anomaly or what have you. And I'll share the chart right now and you can see really how it stands out. Sorry, Keith, that was
Steve. Are you sensing the excitement from Rich as well? I am too.
It isn't. You said it. It's like if you're not excited by these kinds of things, then you're in the wrong business. And my nerdisms, I guess, came out.
Yeah, well, no, it's funny because like Keith, you mentioned like, hey, something's going on behind the scenes here. We don't know what it is, but something has kind of flagged the Fed there. I think some of the reporters there in the press conference asked him. He says, "Well, no, we're just, we're happy with like where the labor market is. We're just trying to be basically proactive and sort of maintain what we already have." It was basically what he said in plain English. But it's interesting because it kind of when you unpack it a little bit further, so the Fed officials, voting members or whatever, they're still expecting 50 basis points by the end of the year, an additional 50 basis points by the end of the year. But they increased their rate cut expectations next year. So they added an extra 75 basis points more in cuts. So a total of 200 basis points of cuts is what the FOMC is assuming by the end of next year.
So that's in addition to the 50 that they just did. Yeah. So that the presser, I thought it was really disappointing. It happened the way I thought it would, and that everyone asked the same question 10 different ways.
Softballs down the middle.
Yeah, it is what it is. But there were 2 questions that should have been asked, and it would have solved everything. So the first question should have been, is there a major country economy outside the US in economic or financial trouble right now? Again, you go to the big 4, China, Japan, the BRICS and the Europeans. You just ask that question. And then the next question is, are you implicitly, by being the Fed, are you trying to devalue the dollar to try to bail out the rest of the world? That's all that needed to be asked yesterday. And then you could have asked that 10 different ways. But again, that's, the thinking is the tunnel vision is amazing in our world. It really is. But you have to be, I like to say, have to be thoughtful in this world, in the investment management world. You have to think about what's happening. Because again, I say this all the time, we had over a decade with no price discovery in the bond market, and it just completely distorted expectations for everything, including the real estate world, of course. But we're at this moment in time, and maybe they are trying to devalue the dollar. We don't know yet. Or again, maybe it is one of the other economies is in deep trouble. I think what's also going to happen, maybe I'll say this maybe the wrong way, but I think now with the other central banks, they see this as a green light. I think now it's a race. Yeah, it's going to be a race to zero. So I think now, I know I haven't checked here this morning, but like when the Bank of Canada comes up again, like the conversation is it 25? It's, oh wow, we can do 50. The Yanks just did 50. Now we can do 50. And then the interest rate differential, we're right back to where we started again. Again, like this has changed everything of where we. No, it hasn't changed. Now we're finally at the moment where I thought we would be, and people and investors, protect your money and all that stuff and your jobs, right? You have to see what just happened. And it was pretty loud. It was pretty clear to see it.
So in the spirit of being thoughtful, I think it's also important to sort of play the devil's advocate just really quickly. And that's to reiterate the fact that the Federal Reserve, unlike Canada and the Bank of Canada, has a dual mandate, which is price stability and full employment. And I think it's, the sort of the argument that Powell made was, well, inflation is no longer as big an issue for us. And so now as a governing body that sets interest rates, we can focus on to our other mandate. And by lowering interest rates, we can sort of address some of the weakness that we're seeing in the labor market. So that's the opposite view. But the problem where I agree with Keith and it falls down flat is, number one, 50 basis points, like I said, is a massive, massive change. And number two, he then went on to rattle on like 10 different labor market indicators that are actually doing okay. And so it was, sorry, that I meant in the press conference afterwards, not in the actual press release. And so that's the part, Keith, where I just thought was really funny, which is he was actually making a sensible and cogent argument about how they in fact have dual mandates, and it's sensible for them to shift from inflation to worrying about the labor market, and then proceeded to tell everybody the labor market was not totally fine, but pretty damn good, because
he actually said the labor market is in a solid position.
Yeah, exactly. And, but he literally listed a bunch of them, saying we're no longer as hot as we. One thing he did say, which is very funny and related to Canada, is how the surge in population has hurt unemployment, which I thought a lot of Canadians could relate to, but maybe that's a bit too on the nose.
It seems like that's like the prevailing theme and trend everywhere, is that we've kind of shifted away from concerns around inflation to now there's concerns around the labor market, right? So like, okay, we got to raise rates because inflation is too hot, and now it's like, oh shit, we got to cut rates because the labor market's starting to deteriorate, at least in many of these countries. And so Rich, you flagged Germany before, but China as well. And we kind of talked about Canada's CPI, but and say, okay, well, energy prices is a huge reason why we're back to 2%. So weak demand from China's slowing economy continues to weigh on oil prices. Refinery output in China slowed for a fifth month in August.
Yeah. China's something we're going to have to talk about more and really start to dig into, because there's some real weakness, not only from like equity markets back to the 2008 low, which is ridiculous. We know retail sales are down. We know demand is down, etc. But a lot of things, I think, like the animal spirits. One of the charts I saw was wild. Was like new startups there's been a real sort of break in the way people feel about their own economy, let alone, their impact on global demand, about how they feel about their own economy, meaning people in China aren't starting up as many new companies. The real estate game is sort of bust now, and it's a really big deal going forward.
So if you look now, Bank of Canada is up next on October 23rd.
50 basis points.
100.
Well, that's funny, Rich. 125. So I hear 125. We might be at that level right now. It's almost 40 basis points that's being expected. So if we get another, sort of softish, dovish kind of economic data point coming out between now and then, we'll probably be at 50, for the next BOC meeting. And hey,
the labor market in Canada, Rich, is it's pretty stinky. I mean, Ron mentioned in the pod there what GTA is at 8%.
Yeah,
I mean, that's a small part of the bigger picture, but you have to think the unemployment rate in Canada is still under pressure and should move higher. Most likely,
it will move higher. It's non-linear. Once these things start moving, they continue to move until you get, until you reach your apogee.
What was that last word? What was that last word?
Apogee. It's the
I don't know that one.
The highest point in an orbit.
Okay, settle.
It's like an apex.
How do you spell it?
Oh, I don't know how to spell things. I have a big vocabulary, but my spelling is of third grade level.
Is that how you do it with your girlfriend?
And you have a great smile. He has a great smile too, everyone. But one thing is interesting, one thing that we really value and cherish with the podcast, we get a lot of people sending us emails and calls and stuff. We get a lot of anecdotal information all the time. And for a long time, the narrative we're hearing, hey, business is good, business is okay, visibility is good and everything. And it's kind of shifted now over the last 3 months, is that business isn't as good, or hey, I couldn't hire anyone 6 months ago. Now I'm getting a lot of applicants coming in. So we are starting to see now it is starting to roll over a little bit in that way as well. But again, now I just want to emphasize here, we're going to see some pretty dramatic changes in the economy and markets now going forward. And so start with the central banks. And then we have the U.S. election, of course, coming up. And
which I'm sure will be very smoothly. Let's go very smoothly.
Man, well, it can affect things in a number of ways. I mean, so first of all, like Rich, you mentioned earlier that, that a central bank, they never change rates by 50 basis points up or down at a meeting when there's no crisis taking place, right? So it's just, again, that was odd. Here we are, the Fed, they're 2 meetings away from, the next most important election in the history of Earth. And so for them to do that, is a pretty strong, favorable signal for one party over the other. We have that happening here as well.
They asked Jerome Powell about that in the meeting, by the way.
And that's a good question, right? And you know what the answer is going to be, but it's okay to, to get someone in check here, right? Say, hey, by the way, this could be perceived to be this or that. I doubt most of the world or most of the American voters or even know what the Fed is and what monetary policy is and that stuff. But yeah, we are entering this very sort of very short time frame, impactful moment of 24 here coming up, and is coming right at you.
Live
coming back right at you.
I think that's that's a good place to kind of wrap it up. I think that it's all coming to a boiling point. It seems like I don't know, it makes for these conversations to be really interesting. I always look forward to them every week, but I think this week in particular, just so many changes and big policy decisions, and yeah, like you said, those elections coming up, it's going to be wild.
So everyone, IceCap is going to do a webinar for whoever wants to attend on October the 4th. So 2 weeks from now.
DM
if you want to, Yeah, you can send me a DM. But seriously, we do these probably once or twice a year for the public, and we get hundreds of people coming on. So if you want to attend, just send me a note directly, and we'll send
Man,
you
you
the
really
link
need a better
for 2 weeks.
advertising platform here.
I know, but this is work. But the people who
There should be a link in the show notes.
Yeah. But to be serious, without deflecting away from it, this is a very important time, and people who are engaged, they are interested in the conversation, and people who are not, then it is what it is. But this is pretty awesome right now.
Okay,
from what's happening.
DM Keith on his Tinder profile. All right, that's a good place to wrap it up. Keith, yeah, if you actually want his info, looniehour.ca, all of our bios are there. We've got a what do we have there? An inquiry box where
we have everything. We have our emails, we have our LinkedIn, we have how you can reach us. You can follow us on Twitter.
We have shirts.
We have shirts for sale. We have mugs. The mugs are especially cool. We have all kinds of stuff. That's why you should check it out. Looniehour.ca.
All right. Well, as always, guys, we appreciate the support, and we'll see you next week.